21,293, 96 points higher for the Nifty. For the Bank Nifty and for the small and the mid-cap indices, the rally continues. It is a strong and a good-looking market once again. The market breadth, 1:14. That's the advanced decline ratio for you. Tata Steel, Infosys, Hindalco, ONGC, UPL, all of them are moving in a synchronized manner. Now let's mark IT stocks. That's where the real comeback has been. Infosys has added 21 rupees. There is strong price action in Hindalco, TCS. IT is picking up from where it left yesterday. Insurance stocks, are they getting chopped? Are they getting chopped? Especially Max Life, HDFC Life. HDFC Life down 1%. You've got price action in Max, which again is just taking some time to load up. Just bear with me. In terms of a block deal, there's a block deal in PB Fintech. I want to mark some breakout stocks of yesterday. The one which comes on the top of my screen actually is M&M Financials. We did see a breakout action yesterday. And then I'm perhaps saving the best for the last, IRDA. I mean, talk about market returns, and this is the one. I mean, doesn't matter it's down 3 rupees today, but what really matters is that the 32 rupee stock is now sitting at 120.
Yeah, absolutely, and that's where the stock is after that pop at 50. On its listing day itself, it's more than doubled from there. PB Fintech, by the way, not just the block deal, but it seems that income tax officials also visited their Paisa Bazaar offices. So look out for what this stock does in trade. Anant Raj Industries, marquee investors have been investing via preferential issue. Anant Raj has gapped up 300 plus levels on this stock. There's also Satin Credit Care. The QIP is going to open today to raise funds. They've set a floor price of about 242.81. Satin Credit Care 4.25% higher for this one as we speak. KFIN, PVR, both those stocks have been seeing block deals, so look out for that as well. Texmaco Rail, they've got work order worth about 1,374 crore rupees from the Ministry of Railways, so that's definitely one stock which is in focus. And then there's also Jupiter Wagons, and I think they also yesterday got a sizable order. So that stock as well has gapped up about almost 4% as we speak. What are the IT names from yesterday up to? The likes of Emphasis, the likes of Naukri, TechM, Infosys, Wipro, they all held out yesterday, and today as well you're seeing a through coming in. But one of the other star performers yesterday was SAIL, which surged up over 7% on the futures alone. So that stock will come up for you on your screens. Today it's taking a bit of a breather. But Kunal, not bad at all. It's not a big gap up move, but we're holding on and the bias is positive. Any trades that you're looking at?
Yeah, it's a good start for the indices. Again, 100 plus point for the Bank Nifty and almost 80-90 points for the Nifty. The premiums for both the indices are also at a slightly above par or above average level. That indicates that it's not too much of exuberance already in the start of the day. Now, in terms of opening trade, one of the stocks which I've been bullish on would be Wipro. In the last couple of days, the stock has shown some very strong momentum. So that's a stock which I'll look to trade in the open.
All right, Naresh, let's get in a quick... All right, sorry, Naresh isn't there at the moment. But yes, looking at a pretty healthy setup and no complaints whatsoever, seeing these strong green ticks on the markets. That's his first trade, by the way. He's recommending a buy recommendation on SBI. All right, let's get a move on then and connect with our next guest. We've got Amit Sachdeva, who is the Indian equity strategist at HSB Securities, now joining us on the show to share with us his outlook on the markets. Thanks so much for taking time out. And just earlier this morning, we were alluding to the fact that pretty much all the pieces in the puzzle are together. And this is an extraordinary feat. The fact that global macros, global markets, our own macros, crude, we put it all together, even FIIs have been contributing, are all really working in favor. What is this really painting a picture for the year ahead?
Hi, good morning, everyone. Thank you so much for having me here. I think I recall our conversation a month back, I guess, when market was in a correction mode and I was calling we are middle of a large bull run, if you recall. And I think the reason is that the factors that shape India's strong bull runs are coming together all at the same time and become favorable. That happens very rarely. So I think this is one such phase which is very decisive. And when it sets in, it doesn't go away that easily. You may have short-term phases of profit booking with events such as US bond yields rising or even crude spiking in the meantime. But the moment there's a little correction there, you've seen US bond yields now sub 4% and crude has come back to 70. And the rest of the outlook was already very positive. So I see the 10-factor model that we have, which sort of predicts in a way that how bullish we should be. I think 9 out of 10 are so favorably placed. And I think we should expect, as we enter the new year, very decisive bullish phase to set in. And we have obviously election year this time as well, which would have its own volatility and its implication in the market, but that for another point. But at the same time, the factors that shape earnings, valuations, FIs, base of flows to Indian macro, external environment, all coming together for that Indian market could be in a very decisively positive phase. So we remain very bullish. India is a key overweight market for HSBC, and we continue to like India a lot.
How much of the good news is in the price? Well, it's perfect and all stars have aligned, but they say in market, you don't make money when there is cheery consensus. We are at a stage of cheery consensus and markets are at record high. Valuations are at a record high. So one is buying stocks now or holding stocks now. Do you think in next 1 year, are we likely to get double-digit returns, single-digit returns or no return?
Well, that's a great question, Nikunj, and I would probably hazard a guess like this, right? There are obviously two parts of the market. One is the large cap space and there's a mid and small cap space. And if you look at, there's a clear divergence there. If you look at valuation point of view, I think we are in the large cap space has already moved, right? It's valuations are really 5-year average. It's a mid and small cap space which is leading the charge in this rally, which is a typical of bull runs. If you look at last bull runs, we have small and large, small and mid caps tend to rally 1.4 times the market run. We are at now 1.8, which is, I think, is a symptom of that market has also realized that identifying those small and mid caps which are potential large caps. And this is a perfect phases of market where market tends to become risk on and bets on those stocks. And that is very typical for bull market risk taking. And 30 to 40% or number can vary, but these stocks tends to become large and become compounding stories. So for investors, the quest is to find those mid caps or small cap, for example, that can display that characteristic. But in the meantime, we'll also see that rotation keep happening to even some of the left out great quality names, which have not performed in the rally, and FI flows come back. We could see up move there. And by the time mid cap space can also still become a breather, take a breather and then come back. I think we see about double-digit return again in the market. But there is a variable here this year, Nick, which is that political outcomes would also be a determinant of how markets behave. For example, with a 3-state win recently, obviously markets attaching higher probability of political continuity. And if that's the case, the probabilities continue to strengthen as we go along. Market would see more decisive bull runs because there's a political certainty, macro looks good, and that's a key to shaping next 5 to 10 years for India as well. But if there was an adverse outcome, for example, and that's a key risk for the market because market would then tend to correct. And then, as history tells us that after that correction, market would take a breather and then recover again. So in that case, market probably could be flat in the year. But if political continuity is assumed, then we are looking at a strong double-digit return in the market again because it's purely earnings-led, and we have many factors of the market have not yet participated. So we see the bull market would benefit all the aspects of it. While I would also stress out one point that large caps tend to underperform in the entirety of bull run. So you'll see mid cap and small caps tend to find much more momentum as the bull run continues to deepen. But one thing is for sure, we are still in the middle of bull run, and bull runs once set in tends to have a momentum which can last up to 3 years as well. And we are still far away from here.
Quite a few takeaways in there, Amit. But first things first, what will the FI money chase? Would it be the undervalued large caps? Because, size is a compulsion with them.
Sure. So, no, it's a great question. And I think if you see the last September and October, we saw a significant outflow by FIs, about 5.5 billion. In November, we've seen uptick again. In December is uptick again. But my sense is that the way the factors that influence FI money into India, they are back in favor and favorably placed. So I see FI flows continue to strengthen now, which has already become positive, by the way. So it is clear that FI tends to, like size and liquidity and several constraints that come with that money. So it imminently will benefit some of the large caps, which are, seen as winning business models, but have lagged, and that mean reversion could happen for them. So some amount of, immediate uplift could happen there, because I believe FI flows are imminently due, which has already started to happen. And as the year begins, I expect a strong rebound in FI flows.
Samit, while election outcome is important, I endorse that. Valuations are a bit stretched. Now, what should one do then? I mean, if election outcome is not bad, markets could be down 10%, 15%, 20%. That's anyone's guess. The point is, how do we take care of that in terms of bulletproofing the portfolio returns? What should one do in terms of maximizing the gains and protecting the gains?
Nikunj, obviously portfolio managers are very adept at, taking a broader balanced view. But my sense is that 3 or 4 kind of stocks that you could decipher as a sector radars also sort of breaks it down, where the momentum is very high. Valuations are slightly richer, investors are optimistic, but business dynamics are also very, very positive. Right? There are many sectors. Real estate is one of them. Autos could be another. So you'll see that sort of momentum carries on, and interest rates will also help some of these sectors as well. So in some sense, those are momentum sectors that must be played, right? And selectively, of course, there could be pockets of excesses you can avoid, but there's opposite to that would be sectors which are beaten, where the investors are pessimistic and business dynamics are also negative, right? Say IT would qualify there, which we have seen. Now, when the market is in a risk-on mode, market is taking risk with a one-year view. For example, some of these names would tend to rally, in this market. So one has to also take some of the stocks which are in the risk-on context as well, where the stocks has got hammered in the past cycles, and then this market momentum can help those stocks also recover. So blend with that. And the third would be where, I would say that business dynamics could change for positive, but investors are negative, where large cap banks would sit in that category, for example. So you would blend some of those as well, ideas where you could escape buying expensive valuation, but some sort of mean reversion could play as well. And then avoid some of these names where valuations are run up a lot and business dynamics could turn negative. In these markets, you could see some of these names not perform. So I think blending the 3, some risk on, some momentum, and some winning aspects of the businesses, blending the 3 would be a great idea. And then take a cautious view of names which are excessively valued. So some cautions definitely required, not buying all what has run up and paying all the momentum, but taking a balanced view in this market would help protect people from any major hard landings.
Interesting. So let's delve a little deeper in there, Amit, because, what is overvalued and what's not, that definition is getting a little bit blurry looking at growth and the prices on the screen.
Well, I would probably reserve myself comment to purely at the sector level, where there's a restriction that we are on. But at the same time, I would probably think that in our case, real estate looks on balance looks very good, which blends business dynamics as well as valuations and all the rest of it. So that one sector we really like. In that context, even autos will continue to support a little bit, right? Retailers, I think we also like, because that's some sector which also benefits there. IT, we like very selectively as a risk-on sector, which still qualifies for that. And you avoid, excessive valuations where, valuations have reached way above 5-year means, and that risk management is necessary. I'm not getting into stock-specific details here, and people can figure that out. But I feel that, when the bull market is happening, market is buying risk, but also market is buying momentum, right? And then market is buying a little bit of some of the avoided names as well. Turn by turn, that could happen. So that said, I feel that 5-6 sectors still look good to us, which includes banks, of course.
But isn't bank a crowded trade? I mean, most of the funds are 30-35% overweight on banks. The fact that banks will do very well is more like a ghar ghar ki kahani. Banks are exhibiting strong growth. Everyone knows that. So where is the upside for banks? I mean, either fresh buyers have to come, or some extraordinary triggers have to come, which perhaps may not be true for banks.
My sense is a more mean reversion trade, to be honest, Nikunj, because last year some of the banks have completely missed the rally, and valuations become quite valuable. And then those are the times where you choose some of the avoided names as well. I'm not really going to stock specific name, but you can guess that, right? And so those names can see reasonable mean reversion as the year begins, where the ideas run out on the other side. You could see some of those moments, very, very easy gains can come. Not 50%, but very reasonable gains can be predicted there.
Outlook then, Amit, when it comes to the entire earnings, given that there have been certain pockets that disappointed in the previous quarter, what does the next year ahead hold in terms of profit growth, revenue projections, etc.?
In fact, I would probably think that while, every year that begins in India begins with a very large expectations of earnings, and when we enter the year, earnings continue to get cut. This year has been particularly very, anomalous year in that we have not seen much earning downgrades. Like, in fact, even Q2 was seen to be very, a mixed quarter, but we've seen earning upgrades across many sectors. And earnings, in fact, have held to, very reasonable levels throughout the year. And then, next year also, I don't see expectations are crazy. Like, for example, Nifty earning expectations will be about 12-13%. This year, we are ending at 18. I don't think that 13% expectations are overall basis is crazy. So I'm sense that there could be still upside risk to earning based on how GDP growth and other things settle. But we are not building excessive expectation. Still, India is seen as one of the large growing markets, and inflation being, obviously remaining very, very benign now as we go into the next year. One can hope that earning downgrade risk is also low across sectors. So that paints a good picture, because one thing that obviously holds back market turn in these kind of markets is where the earning downgrades are happening. So we don't see earning downgrade in FY25 because the expectations are not crazy at all. While FY24, if you see, is held up pretty, very strongly, to be honest, across sectors. Barring few, I think we've seen only upgrades rather than downgrades.
Okay, good to have you on board, Amit. Thanks so much for giving us your take as to what lies in store for the markets, as well as your overall outlook in terms of valuations and earnings. A quick check-in as to where things stand, and looking good at 21,253. You've got a lot of names that are powering through. Hindalco, UPL, Tata Steel, JSW Steel, and Infi TCS as well continue to hold out in the green. In fact, the catch-up rally in large caps is due, according to MK Global's Krishna Kumar Karwa. He expects that FIIs will continue to buy into banks. Let's hear out his take.
Some sectors where there is a lot of momentum, news flows, positive news flows, you will tend to see many of the stocks in that segment getting overvalued and maybe discounting 3-4 years forward earnings. And yes, you could possibly say that for some of the stocks that you were mentioning in the course of the conversation. So yeah, I mean, the market seems to be in a lot of tailwinds also, actually, honestly speaking, after the state election results and now what the US Fed has indicated as far as interest rate trajectory going forward. So these only add to the overall positive momentum which was always there, which is in terms of the domestic GDP growth, IIP numbers, robust inflows from domestic investors, and now hopefully going forward next year we should see very robust SBI inflows, and and that should lead the large caps which have relatively underperformed versus the small cap, mid cap the last 1 year. I think a huge catch-up rally in the large caps is on the way.
Okay, I'd like to draw your attention to the big pivot by US Fed. Interest rates have peaked out and they will come down. Now that's a very powerful change for the market. 2021 and 22 and 23, we had to deal with rising interest rates. Now interest rates, they come down. What will happen because of that?
As I said, one is that the whole soft landing of the US economy, that kind of is given once the interest rates start correcting, and that should also obviously give an impetus for flows to move out again from the US to other emerging markets. And India could possibly be a prime beneficiary of that. Right. And more than that, I think also if you feel that the US economy is stabilizing or rather soft landing, then the whole economic atmosphere over there, or rather all the IT companies, they should see the positive benefits out of it in terms of all the decision making which was kind of deferred at their end. I think all those things should make a comeback. So from that perspective, if I were to look at it, then good news flows for Indian companies because of the US economy stabilizing or achieving a soft landing and interest rates coming off. Plus valuation multiples. I think falling interest rates would always obviously lift the valuation multiples also.
Sure. So within large caps, given that you are betting on large caps catching up with what the broader markets have done so far this year, what's going to lead that catch up?
So obviously, I think it is the financials and possibly the IT companies. I think they should be the ones which should drive the large caps, and financials have relatively underperformed in the last 12 months, and now they have started catching up. So obviously, that's one segment which should possibly do very well. And IT companies, again, I think they had headwinds in the last 3, 4, 5 quarters, and the stock prices have also reflected that. Now, if they start getting positive news flow, I'm not saying it's going to happen overnight, but maybe in the next 2 quarters, we should possibly start seeing the positive impacts as the US corporates assess the economy and take forward their decision making. So that's one opportunity where in a rising market or in a robust euphoric market, valuations are relatively reasonable. Yes, growth is muted. But if growth makes a comeback, then that's where again investors would like to invest in. And yes, if SBI flows are going to be, they are going to more and more go into large caps. Small mid caps cannot absorb those kind of flows also.
So I'm just spending a lot of time here, KK, with you, because we are trying to understand that, okay, interest rates, they come down, growth stocks, they come back. What is growth? I mean, growth, let's say a couple of years ago, IT was growth. Then defense became growth. When we say that valuations come down and growth stocks go higher, what end of the growth cycle in India, specifically, if you can break it for our viewers, will benefit because of a rate cut cycle?
If you look at the robustness of the Indian economy and the way your credit growth cycle is, so that's possibly a 15-20% kind of growth which is there for the credit for the banks and the NBFCs. I think that is the segment of growth that you should be looking at. If you look at the consumer companies, FMCG companies, they are struggling. They are struggling at volume growth of 3-4% and below that. So growth for India basically means that the top line growth for companies that you're looking to invest in has to be 15% plus. And that you can possibly see in auto companies, you can see in cap good companies, you could see in financials. I think those are the segments where you see that kind of robust growth on top line basis, and accordingly your bottom line also grows equally well. So earnings growth have to be plus 15% plus for investors to be interested in. So if you're asking me where is growth, or where investors will invest in, investors will obviously invest in these kind of companies where the bottom line at least 15-20% kind of growth and top line can be at least 15%. I think that is the growth segment that one is looking at, and anything below that is not par for the course.
Now let's understand the financials. Now, okay, financials are in a great spot. NPA cycles are low, growth is decent, and there is no challenge whatsoever in terms of any NPA coming near term soon. But this is a template which markets are aware of. This is a sector where positioning is very high. So how does one know whether all the good news banks is in the price or not?
A good question, Nikunj. I think if you see in the last 12 months, so wherever there was over ownership in the financials, I think those companies, despite the best of fundamentals, were unable to reflect that in the stock price performance. But having said that, some of the tier 2, tier 3 participants where there was relatively under ownership, those stocks have given phenomenal returns. I think the constraint was the FPI inflows were not so robust, and so you require huge amount of FPI inflows to be able to buy into these top tier banks. So if top tier banks, if you see positive SBI inflows, then top tier banks would again see that buying which is required. So there's nothing wrong in terms of what it's all about, over ownership, under ownership. Similarly, if you see of late, the domestic mutual funds, also the large cap focused mutual funds, have also seeing robust inflows, which will give them the headroom to be able to buy into some of these top tier banks where they are reasonably reasonably owned. But once more inflows are there, they should be able to buy into them more.
It is the perfect bachelor pad.
तो कब लेना है आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में, कुछ साल लगेंगे अभी।
इसलिए Housing.com का हाउसिंग असिस्ट फॉर रेडी प्राइस मैच एंड वेरीफाइड बायर्स। Housing.com, पोस्ट योर प्रॉपर्टी नाउ।
Thanks for staying on with us. Still tuned into First Trades. And yes, a lot of stocks are flying high. IT, by the way, included into that list after the pretty spectacular rally that we've already witnessed. So let's understand if the good times are ahead for Indian IT as a sector, what the outlook is on large caps versus mid caps, and more importantly, what is fueling this optimism. We've got Ashank Desai, who's the VC and MD Mastech, as well as DD Mishra, Senior Director Analyst at Gartner. Thank you both so much for taking time out and joining in. Mr. Desai, I just want to understand, after having flagged off a lot of muted growth concerns, deal win momentum perhaps slowing down, I'm talking for the IT sector broadly, what really is fueling this move within the IT space?
So, thanks for inviting me here. It is very nice to be at ET. Good morning to all your viewers. So, few things which have been uncertain over last 2 or 3 quarters seem to be melting in a very slow way. That's the way I would put it. So, for example, there is this whole issue of US recession, and what would happen to that is one point which was coming up. Now that Fed has said they are unlikely to raise any interest, and also there doesn't seem to be any slowdown indicators in US economy by vacancy of jobs or growth results of the IT companies and so on. So there is a positive mood that it won't be as worse as it was thought 2-3 quarters ago. So that's point one. Point two is all the IT companies really have booked large number of orders over even last 2 or 3 quarters. Although the performance on the revenue was not high, the order booking performance was quite good. And some of that will now get translated into the revenues after in the coming quarters. So that is second reason. And third reason, of course, is overall there is a positive, what should I say, mood that IT is driving the economy, and we need to again re-energize it. So I would put all these 2-3 reasons together.
Mr. Desai, good morning. Nikunj also joining in. Now, I just want to put a simple fact out. IT companies are getting orders. If I look at the TCV or the deal wins, the orders are coming.
Yes.
But orders are taking a lot of time for translate or to perhaps come into revenue stream. So if I'm an IT, let's say client, I would say that मैं order दे रहा हूँ, मगर order start नहीं कर रहा हूँ. Why is there so much of confusion?
Question to whom?
Mr. Desai, it's for you.
I see. Okay. So it is like this. One must understand the nature of the orders also when they come in. If the nature of the orders that you have got are of a longer time duration, you see, each of these orders, when they come, they have time for the execution. When you get an order, sometimes you get an order which has to be executed in 1 year. Sometimes you get a 5-year contract which has to be executed. We also get it. Both we get it. If your order booking is more going to be the longer term driven, then the execution will not be seen immediately in next 2 or 3 quarters. That's a fact. That's one. Second, as you also said, I agree that if there is some uncertainty in the minds of the CIOs, they may not accelerate the execution of even existing orders. That's true. To some extent, that is also true. So both of these reasons are important to decide what will happen to the orders.
Mr. Mishra, I want to get you in on the discussion as well. You know, while the equity markets, of course, are doing what they're doing with the IT stocks, what's the reality on ground? I mean, come the January earnings, can we see any glimmer of hope? I mean, can we see client spends actually see an uptick coming in? What's the prediction for 2024 like?
So good morning and thanks for having me here. And I have been very consistent in telling that 2024 will be the return of growth. And from a Gartner perspective, we have been forecasting the IT services growth for quite a long time. And every quarter we revise our growths. And I have been observing very closely our forecast, which we have made, and we see that 10% around growth on IT services spending. End user spending is going to happen, and that is going to remain consistent for next 2 to 3 years. So we see a very positive mood at this point in time from IT services perspective. There is no reason for much of concern. And of course, there are certain things which we need to keep in mind. And I agree with Mr. Desai that when he said that there has been some sort of conservativeness. In the IT sector, the change fatigue has been there for a very long time. And this is something new, which I am going to tell you that what we are seeing that CIOs and CEOs and CTOs are actually scrutinizing their IT spend more closely. And until and unless they see that real business case of value coming out of it, they are a little bit hesitant to make that particular spend. Of course, the economic turbulence, geopolitical uncertainty, supply chain disruptions, and inflation and skill shortages are also trying to slow it down to a certain extent. But having said so, we see that overall, the IT services spend is going to be nearly in double digit, which we have not seen in decades.
Are you factoring in the disruption, Mr. Mishra, which could come in because AI? Does your model capture that?
So yes, the disruptions which can be caused by the AI, and maybe you are referring, AI is not new. AI has been there for donkey's years now. What is new is the impact of generative AI, which you may be referring to. Now, generative AI is something new. It is emerging, it is evolving, and we don't know what we don't know yet. And there are not many serious players in this particular space who have the skin in the game. And what we have seen so far, that there are not many use cases which has gone to the production stage, bearing few. And we are yet to actually observe a real business value coming out of it. So next 2 years, there is no big concern for the IT services companies, but I'm more worried about what is going to happen after 2 years from now.
Mr. Desai, there is good old debate on what will happen to the core IT model. Now, there is a thought which says that, look, Indian IT companies have a model which is a model centered around outsourcing, centered around manpower, who write codes, and that's how billing starts. Guess what? AI is going to change everything, and the whole concept of billing per employee is going to change. Is that a real fear, Mr. Desai, that the core IT services model will have to be rebooted really from a client standpoint, and that will have impact on the way our future margins and businesses calculated, Mr. Desai?
See, you have to look at the whole IT portfolio of IT industry today. It includes, of course, ITES, which is BPO companies, and then there are IT companies who, like all of us, who build applications. Within applications, again, there are multiple strands. There is a strand which is about new application development and discretionary spend. Then there is an implementation of large products like ERP systems, like CRM systems, and so on. Then there is a third strand, which is about basically maintaining the old code. Now, the whole impact of AI, if at all there, is going to be only in that first area of application development. And application development will have impact in terms of productivity gains of AI. And obviously, some of the requirements we'll see higher productivity and lesser number of people and so on. But its overall impact is going to be positive. I'll tell you why. What really happens is, and I have seen IT industry for the last 40 years, any productivity improvement that happens in software development creates more demand for applications, which is more than loss in hours because of productivity. So it has always been a positive cycle. A person like me who had done, coding based on the punch cards some 40 years ago, it used to take so long a time, and now it takes 1/100th of that time. But programmers needed are 100 times more than what, or 1,000 times more. So the point I'm making is productivity gain is generally a positive indicator. So I don't see some cataclysmic impact on the IT industry. Yes, there will be some short-term issues that we need to sort out in terms of some of the things that you have said. I'm not ruling that out. But in overall longer-term gains, I do strongly feel that productivity will improve the demand for new applications. And I'm seeing it. Customers are right now asking for applications to be built around AI, which we would not have done without AI. AI makes it possible now. In the healthcare industry that we are very active, we are talking of customer servicing requirement. Now, I would have done it without AI, but it would have taken a long time and they were not wanting to spend that much money. But now they are saying, oh, you can do it better, faster. So there is a positive impact of productivity improvement, is the point I'm making.
Mr. Mishra, just wanted to get in your take then in terms of the nature of deal wins. Do you think that that it's largely going to be large cap or niche mid cap?
Whom are you asking?
I'm asking Mr. Mishra.
Yeah, so actually, I would not divide it into large cap and mid cap, but I would actually discuss the nature of the deals more. And what we have seen that, large deal make much bigger noise. But is it a reality that we are having too many large deals at this point in time? The answer is no. We still see that, the deals which are kind of mid-sized deals and best of breed providers are being aligned to the specific bundles, and that way, multi-source deals are more of a reality at this point in time. Over a period of time, will it shift to much more bigger, large deals? On total outsourcing, is it going to are the total outsourcing contracts going to return? I'm not very sure about this at this point in time, looking at the trend, but we need to keep an eye on it. But having said so, at this point in time, I often get calls from end customers that, can you tell us more providers who are not represented in some of our reports like Magic Quadrants? And that is a kind of reality where we have to share a large number of options and the range of options to our end customers, where they try to look at more flexible and more agile players who can do the job for them, because agility and flexibility are becoming more key, along with the competitiveness in terms of the cost as well. So these are some of the shifts which we have seen. We have also seen that the shorter term deals, 3 years, are more common. 3+1+1 is more relevant at this point in time. And these kind of deals which are taking shape at this point. We have also seen that role of a service integrator and multi-MSI player or a SIAM player, service integration and management, is becoming more and more important. And a lot of SIAM players are now getting a lot of businesses, and around 25% of the deals which we have seen are revolve around service integration and management. So there are, shifts which are happening, and these shifts have been happening for last 1 decade. And this is going to continue as we see more complexity in deals and more complex environment coming up, which is going to shape up the future of IT services.
All right, gentlemen, thank you for giving us a lot more clarity and perspective as to what the deal wins, the overall impact of AI is going to have, as well as the outlook for the IT sector as a whole. It's been good having you on board. All right, and that's the IT index. Nothing short of a pretty stellar move, but it's across the board. So we'll take a very quick break. Be right back as we discuss NBFCs as a sector.
Okay, back with the market in first trades right here on ET now. Let's just take stock of what else is happening in the market right now. While, it has been a decent start, we are holding around the 21,250 mark in trade, 76 points higher. JSW Steel, Hindalco, Tata Steel, ONGC, and technology once again is the one which is actually holding up. Look at Infosys, that's holding up about 2%, and similar is the price action on an LTIM, HCL Technologies, etc. as well, looking very, very smart. And the broader market too, extremely lively. So you've got a GNFC holding up 3%, Delta Corp is higher by 3.5%, Hindustan Copper is looking very smart, and one of the biggest movers today is Deepak Nitrite. That's seeing an over 5% move in trade. Deepak Nitrite will just come up for you on your screens, and that's not how the stock started off trade with a gap up, but it's been a very, very consistent build up that you've seen in this particular stock. But let's just throw light on what's happening within the entire NBFC pack. Are they going to really hit the reset button in the time to come? There are tighter RBI norms which are turning out to be a bit of a sore point for NBFCs. If the rate cuts set in next year, what's really going to be the state for NBFCs? So let's try and understand all of that. We have Shweta Daptardar joining in, Vice President at Elara Securities for their Financial Services Division. Shweta, hi, morning. Great to have you today on ET Now. Shweta, help us construct what the current ambience is for NBFCs, both the good as well as the bad.
Hi, morning. So as you rightly pointed out, we are approaching a rate down cycle. But at the same time, we have to be cognizant of few things. One is post the Fed meet, it's very clear that RBI will also join suit next year, which the market is pricing in, and hence the euphoria. But like I said, we ought to be cognizant of a couple of things, like we are still in a high interest rate environment in terms of cost of funds spike, which is clearly visible even today for NBFCs. And the reason being, so look, MPC decision comes with a lag impact on the financial services sector. So the 250 bips spike of interest rates or repo rates still will have slight bearing on net interest margins for whole of FY24. It's only in FY25 that we'll be seeing positive impact on net interest margins owing to beginning of rate cycle. Point number two, NBFCs had also raised borrowings at higher interest rates, which are still coming for repricing on the higher side as on today. So again, that will have another bearing on net interest margins for this year. On the positive side, what we have seen is the growth runway remains very strong. So we remain positive on few subsectors such as one, power financiers, wherein the capex cycle, the government impetus on renewables remain very strong. We are also entering a positive infra cycle, which will have positive bearing for these financiers. Two, microfinanciers are again on a strong growth runway. So another 1.5 years, you will continue to see microfinanciers doing strong. The RBI regulations have been supportive with removal of cap on net interest margins. Third, we are positive on gold financiers. So primarily, we preempted this a few months ago with the new RBI norms coming on increased risk weightages for banks to NBFC lending. So in such a scenario where risk weightages are going higher, where unsecured retail credit is being clamped down, then definitely this will have positive impact on gold financiers. And with the gold rally underway, I think this is the third sector you should be looking at for next 1 year.
In your understanding, how much of the NBFC book right now has unsecured as a category? Because that's where a big slowdown is likely to happen.
Right. So actually, see, the larger part of the problem is more into less than 50,000 rupees ticket segment, wherein the data is not reported. So it's very difficult to gauge as to how much pain is there in the system. The reason that RBI came up with a cautionary note is primarily because of the aggression that has happened on the lending side across financiers. So last 1 year, if you see, the retail unsecured credit has grown by 30% year on year basis as at the end of FY23. We have also seen certain spikes in portfolio risk for consumer credit for credit card portfolios. So the data and the aggression is suggesting there might be delinquencies that is coming through. But as on today, the kind of interactions we are having with the management of NBFCs, at least for today, there is no such immediate sign of worrisome. But yes, when the cycle turns down, we have to remain selective and stay alert as to the build-up of this risk on the portfolio.
What is the right way to look at the price to book of NBFCs? You know, there is a Manappuram Finance sub 1-time book. There is a Bajaj Finance 8-time, 10-time books, depending on the estimates you look at. What is the right price to book for the NBFC sector?
Yeah, that's a very interesting question. See, typically for NBFCs, the good keeps getting better. And unlike other sectors, NBFCs valuations are, even though they might look optically expensive, they continue to remain there if the underlying quality of the management and the growth story remains intact. So largely the valuations for NBFCs are outcome of growth, sustainable growth, structural story, and definitely the quality of the management. Pointing out specifically on the gold financiers, yes, we have seen a huge valuation gap there, but I think this should also eventually narrow down. Most of the NBFCs are now, as we know, are doing operating systems re-engineering. They are focusing more on rebuilding of systems on the digital and technology side. There are diversified books that are coming to surface, which will help in customer retention strategies. A lot of competitive intensities are flaring up, especially from the bank side, as now data is easily available. So I think NBFC bull run should continue, but at the same time, we would like to remain selective because the risk built up, on the other hand, is something which we cannot ignore.
When the entire rural economy is under stress, why is microfinance doing well? Why is every microfinance company or so-called microfinance bank coming out and saying that we have no problems, there are no NPAs, we don't know why rural economy is slowing down, hamari book to achhi hai. How can that happen?
Yeah, so two things here. One is rural economy. If we talk about rural economy, it's more about agrarian economy. So farmer incomes or cash flows on the rural side are definitely have definitely remained tight. If we talk about specifically for microfinanciers, we have to get one thing clear. Microfinanciers do not give loans for crops. They are not direct. So the microfinance customers are not directly farm income based customers. These are small entrepreneurs, mom and pop stores, say cateries, businesses, so the and the likes. So microfinance growth story, like I mentioned in the beginning as well, remains strong at least for next 1.5 years. But you're right to an extent, the customer vulnerability there remains strong as we have not seen very positive signals on the rural side. So we always advise clients on microfinance side that you should leave something on the table and exit strategy should remain in place. But as of now, microfinance, as you rightly pointed out, especially on the margins, from the margins perspective, because there is removal of cap on net interest margins by the RBI and nothing as such, no reversal of such decision is coming through. So which has kept these set of companies in limelight.
One set Shweta, and the other one are the power financiers, the fancy of the market right now. I mean, look at what's happened with the PFC, REC, or for that matter, and IREDA, the kind of re-rating that the entire sector has got, more so after this recent listing. Tell me, how do you think this entire story is placed vis-a-vis the kind of valuations that these stocks are quoting at?
Right. So power financiers have been the talk of the town, and primarily because power today is a very structural story. There is huge government intervention in terms of distribution portfolio or Discom's health. Third, the power capex has remained strong, 2,800 billion kind of capex, which is allocated across power sector for FY23, will translate into at least 15% disbursement growth across power financiers. So a lot of positives there. There have been significant asset resolutions that have happened for these companies. And as you rightly pointed out, the valuations have remained attractive, although these companies have posted best of the ROEs. So given the fact that next 3 to 5 year power story remains strong, I think power financiers will continue to remain in their healthy bit, and we would see more of growth coming from the renewable side with the new focus. As you rightly pointed out, IREDA, which listed, has seen more than 100% price increase already. So I think there's a lot of government push and initiatives that is also sort of supportive of these valuation re-rating that we've seen.
Shweta, thanks so much for joining in and painting a clearer picture as to how things stand when it comes to the entire NBFC pocket. Let's move right on then and put the spotlight on Chartbusters. We've got Kunal joining in to tell us some of his interesting Chartbuster ideas. So let's find out, Kunal, what's the chart that you're tracking today?
So I'm looking at the charts from the IT index, and that's Wipro, and how the stock is poised vis-a-vis with respect to the other large cap names like TCS and Infosys. Now, particularly Wipro made a major high, which was I think 2021 second half, closer to the 700-750 range. From there on, the stock had fallen very sharply. As you can see that in the entire 2023 and the second half of 2022, the stock went into a major time-wise consolidation. So it started to trend to a range. 440 approximately was the upper end of this range for the stock price, and closer to this 350 odd mark is where you saw the stock making a major bottom for itself. So it spent a major corrective phase, more than a 50% correction already completed for Wipro, a 1.5 odd year of time-wise consolidation, and as you can see that the stock is now forming a rounding bottom pattern. So it's coming very close towards the breakout of this. The Nifty IT index is overall looking quite charged up. You've seen TCS, Infosys looking quite strong and inching towards a breakout. I believe if Wipro gets into a breakout mode over here, it could be one of the more swiftest large cap IT stocks, which could at least come back towards the previous swing high, which is approximately 600. So a decent upside is what I'm expecting for Wipro over the very near term.
Okay, that's the Chartbuster idea on Wipro. What about other stock ideas, Kunal?
So I'll go with two buy calls. The first one is about Amber Enterprises. That's a stock which is confirming a reversal after almost 2 weeks of correction. So buy with a target of 3,500, stop loss at 3,200. And Info Edge is something I would highlight again as a buy, targets of 5,400, stop loss at 5,000.
Okay, let's take a very quick break. Then on that note, we're holding on, inching closer to 21,400 on the Nifty futures, and we've scaled it to 21,300 on the spot Nifty. Quick break, be right back with more.